Yep, the markets have once again opened with major losses this morning. There it is. Let's bring in CNBC senior markets correspondent Dom Chu. Dom, what are you watching here?
All right, so Mika, Joe, Jonathan, as we're watching another 1,300-point drop as we see things in the Dow developing right now, it's kind of important to put some of the context around it. In the 2 days since really the tariff announcements have come out and we've seen that 2-day market reaction for Thursday and Friday, data from S&P Dow Jones Indices now shows that 2-day drop in market value at just around nearly $6 trillion from the U.S. market wiped out. If you look at it from the record highs that we saw back on February 19th, that same data shows a nearly $11 trillion drop in the value of the stock market here in America since those record highs.
Something isn't adding up in the stock market right now. We just saw one of the biggest single-day rallies in years. But what if I told you this wasn't a sign of recovery, it was manipulation? This week, former President Donald Trump announced a 90-day pause on many tariffs, except on China. That statement alone triggered a massive market surge. But right before that news, Trump told people to buy stocks. That's raising serious red flags. Now, Senator Adam Schiff is calling for an investigation into whether Trump or his associates may have engaged in insider trading or market manipulation.
This is Charles Schwab. It's not just a company, it's actually an individual. And he made $2.5 billion today, and he made $900 million.
But this sudden spike? Textbook behavior for a dead cat bounce, a short-term rally in a longer-term downtrend. These bounces trap retail investors, only to collapse once the real pressure resumes. Add to that China's response, an aggressive 84% tariff on key U.S. goods, and we've got the recipe for something much bigger than a bad week. This will ripple through industries. Agriculture, manufacturing, tech, layoffs and closures are coming.
What we're seeing right now is not a sign of recovery. It's a reaction to uncertainty. This is textbook market whiplash, driven by headline risk, not fundamentals.
Sarah Cheng, senior strategist, Black River Capital. When we overlay current market patterns with those from the dot-com bust or 2008, we see the same classic behavior: volatility spikes, false recoveries, then sharp breakdowns. We're not out of the woods yet. Dr. Marcus Levin, chief technical analyst, Invictus Markets. In fact, analysts at Bank of America have updated their recession probability to over 70% by early 2026, with corporate earnings expected to decline 15% to 20% across key sectors. If this happens, historical precedent suggests the market could drop as much as 50% from its current peak. Analysts at Morgan Stanley recently warned that we're likely in the late stages of a bear market rally, and they estimate the S&P 500 could fall another 30% to 50% from current levels if tariffs escalate and growth continues to weaken. So here's the reality. This historic rally might just be the eye of the storm. With global trade tensions rising, insider trading accusations in play, and macroeconomic cracks forming under the surface, it's not the time to be chasing green candles. If this is a manipulated bounce, it won't last. And if history is any guide, the fall that follows could be brutal.
You got knocked up out, man! Give me my goddamn money!